Usually when we talk about a medical diagnosis, there's this expectation of clinical precision.
Right. Yeah. Like a broken bone.
Exactly. You break your arm, the x-ray shows that jagged white line, and the doctor just points to it and says, there's the fracture. It's completely binary. It's visible.
But then you step into the world of the global economy, and suddenly that x-ray machine it's utterly useless.
It really is. Trying to get a clean read on the current financial landscape right now, it's like trying to read a compass inside a magnet factory.
Oh, that's a good way to put it.
Right, because you've got inflation data pointing one way, you've got jobs reports pointing another, and then consumer sentiment surveys that seem to just completely contradict both of them.
Yeah, it creates this deeply confusing diagnostic landscape for anyone trying to navigate it. I mean, economists are endlessly debating whether we are in a recession or experiencing a soft landing, or if we're, already in a recovery phase. They all bring different charts to the table, and they all tell a completely different story depending on which metrics they decide to highlight.
But what if the best diagnostic tool we have isn't a chart at all? I mean, what if the most accurate economic indicator is simply a round piece of black rubber?
That is the big question for today.
Welcome to today's deep dive. For this one, we're looking at the complete transcript of the Q1 2026 earnings conference call for the Goodyear Tire and Rubber Company. This features their CEO, Mark Stewart, and their CFO, Christina Zamarro.
And we should probably clarify up front that analyzing a 128-year-old tire company headquartered in Akron, Ohio, it isn't just an exercise for automotive enthusiasts or, just finance professionals.
Well, not at all.
This is really for anyone trying to understand the physical reality of our current world. An earnings call for a global tire manufacturer acts as it's like a real-time ground-level diagnostic of the entire global economy.
And as we always do on Talk Tickers, we are going to be data forward, opinionated, and hopefully give you some actionable insights. Because think about the reach of this single product for a second.
It's massive.
Right. From gasoline hovering over $5 a gallon and commercial freight recessions to complex Middle Eastern geopolitics and this deeply polarized consumer recovery we're in, tires touch literally all of it.
They really do.
If a physical product needs to be shipped across the country, if a commuter needs to get to their office, if raw materials need to be extracted from a mine, it all fundamentally rides on rubber.
And the sheer scale of the operation is what makes the data so revealing here. We are looking at a company dealing with everything from highly volatile petrochemical supply chains to the nuanced psychology of a consumer just standing at a retail counter.
Yeah. So our mission today is to cut through all the Wall Street jargon. We want to decipher what Goodyear's financial results actually reveal about the modern consumer, the ongoing supply chain puzzle, and the company's aggressive, maybe somewhat risky pivot toward the luxury market.
And along the way, we'll explain the mechanics behind the acronyms, the metrics management uses, basically how they measure their survival.
Okay, so let's unpack this. We want you, the listener, to think back to the last time you bought tires.
Right.
Picture yourself in the waiting room of that local auto shop. When the mechanic presented you with the options, what actually drove your decision?
Did you hunt for a bargain?
Exactly.
Yeah.
Did you immediately ask for the cheapest safe option available? Or did you invest in the premium, high-performance, weather-ready tires? Because as you'll soon hear, that single choice made by millions of consumers is actively reshaping the global manufacturing strategy of this entire legacy brand.
It's shifting everything.
But before we can look at the road ahead, we need to inspect the dashboard. We need to see what the headline numbers from the first quarter of 2026 are actually telling us.
And the headline data, it presents a really significant challenge right out of the gate. So first quarter sales hit $3.9 billion.
Which sounds like a lot.
It sounds like a lot.
Yep.
While that remains a massive figure in absolute terms, it actually represents a 9% drop from the same period last year.
A 9% drop in revenue. Wow.
Yeah. And the decline becomes even more pronounced when we look at the physical volume of products moved. Overall unit volume, so the actual number of individual tires leaving the factories and entering the market, that dropped a steep 12%.
That's rough. I mean, a 12% drop in physical volume is a severe contraction. And the profitability metrics, they reflect that strain. So segment operating income, which they call SOI, landed at $95 million. But when you look at the bottom line through the lens of non-GAAP earnings per share, the company actually reported a loss of 39 cents per share.
And we should take a second to understand why they emphasize non-GAAP figures here. So GAAP stands for Generally Accepted Accounting Principles.
Right, the standard rules.
Exactly, the standard rules every public company has to follow. But companies often report non-GAAP numbers to give investors a clearer picture of their ongoing everyday operations by stripping out one-time unusual expenses.
Sort of smoothing out the anomalies.
Right. In Goodyear's case, they are undergoing massive internal restructuring and paying really significant taxes tied to those moves. So management removes those specific non-recurring costs from the equation to show what the core tire selling business actually earned or lost.
And even with those costs removed, the core operations still operated at a 39-cent per share loss for the quarter.
Exactly. Still a loss.
Which is a bearish signal right off the bat if you're holding the stock. And a massive driver behind that volume drop and that subsequent financial loss was lower consumer replacement demand.
Big time.
The Americas region saw volume plummet by 17%, and the EMEA region, so Europe, the Middle East, and Africa, they saw an 8.5% decline. And throughout the earnings call, management repeatedly pointed to this single phenomenon causing the contraction, the big buzzword of the quarter. Destocking. Destocking. Yeah, to understand destocking, we kind of have to look at the psychology of supply chain management over the past few years.
Following the severe global supply chain bottlenecks of, the previous years, distributors and retailers developed this deep fear of running out of inventory.
The pandemic hangover, basically.
Basically. A massive warehouse that supplies regional auto shops or a major retailer like Walmart, they couldn't afford empty shelves. So in the late quarters of the previous year, they aggressively overordered. They built this massive buffer of tire inventory just to feel secure.
They hoarded inventory because the cost of having no product to sell was viewed as, worse than the cost of storing too much product.
Yes, and that calculation has drastically shifted in 2026. Interest rates remain elevated, which means the cost of financing that massive warehouse full of dormant rubber, it's eating into the retailer's profit margins.
Oh, that makes sense.
So these distributors are now highly motivated to clear out their existing inventory to free up capital. Instead of ordering new shipments from Goodyear, they are simply selling down the massive piles of tires they already have.
Okay, here's where it gets really interesting. From an investor perspective, the CFO, Christina Zamarro, made a critical distinction on the call between sell-in and sell-out. And understanding this difference is the only way to make sense of the real-world tire market right now.
It's crucial.
So sell-in is the moment Goodyear ships a batch of tires to that distributor or that large retailer. That transaction is what Goodyear records as revenue. Sellout, on the other hand, is when that retailer ultimately sells a set of tires to the end consumer. You walk into the shop.
And Zamarro noted that sellout is currently performing much better than sell-in.
Right.
The end consumers are still driving into auto shops and purchasing tires at a relatively normal, steady rate. But because the shops are fulfilling those purchases from their massive backroom stockpiles, they aren't triggering new wholesale orders from Goodyear.
So the actual physical demand out on the highways hasn't dropped 17% in the Americas.
Not at all.
It's basically an optical illusion on the balance sheet. The real-world consumption of tires is steady, but the wholesale ordering has hit a brick wall while the retailers digest their backlog.
But an optical illusion on a balance sheet, it still inflicts very real physical pain on a manufacturing plant. Yeah. This dynamic triggered what Goodyear refers to as an unabsorbed overhead penalty. And that resulted in an approximate $90 million financial headwind projected just for the second quarter.
That is a brutal number to swallow. Let's break down the mechanics of unabsorbed overhead, because a tire factory operates under intense physical constraints. It's not like a normal office. I always like to think about this like a massive commercial bakery.
Okay, a bakery, I like that.
Yeah. So if a bakery normally bakes 10,000 loaves of bread a day, they have these huge industrial ovens that must be heated to extreme temperatures, and they have to run 24 hours a day. The electricity to keep those ovens hot, the rent on the building, the salaries of the floor managers, those are all fixed costs.
And a tire plant relies on similar but far more extreme continuous processes. You have massive Banbury mixers that blend raw rubber with carbon black and chemicals, which require just immense electrical power.
Right.
And you have vulcanization presses. These are essentially giant high-pressure molds that use intense heat to cure the chemical bonds in the tire and imprint the tread. Bringing a vulcanization press up to the correct temperature takes significant time and energy. You cannot simply turn a tire factory off at 5:00 p.m. and turn it back on at 9:00 a.m.
You just can't.
They're designed to run continuously near maximum capacity.
It's like a traffic jam, honestly. Destocking is like a traffic jam on the highway. The cars up ahead, the tires at the retail level, they've suddenly hit the brakes, causing this massive backup all the way at the factory level. So when wholesale orders drop by 17% because of destocking, the plant manager is forced to cut production. But they still have to keep the massive infrastructure running. If they're only producing 8,000 tires instead of 10,000, those massive fixed electricity and facility costs are now divided among fewer finished products.
The overhead costs are no longer being absorbed by a high volume of goods. The baseline cost to manufacture each individual tire suddenly skyrockets, destroying the profit margin on the tires they are selling. That mathematical reality is what generates a $90 million headwind.
But wait, that makes no sense. If management knows the destocking is temporary, right? And they can see the sellout data proving that consumers are still buying tires at the retail level, why is the market punishing them so badly for a temporary inventory clearing exercise?
Well, because destocking is only a fraction of the problem. CEO Mark Stewart provided a very specific breakdown of that massive volume drop in the Americas, and he divided it into 3 equal buckets. Only 1/3 of the decline was attributed to this temporary destocking phenomenon.
Okay, so what's the rest?
The remaining 2/3 reveal deep structural shifts in how Goodyear does business. 1/3 was driven by aggressive competitor pricing, essentially an industry price war. And the final third was driven by what management calls deliberate portfolio optimization.
Deliberate portfolio optimization. I love Wall Street speak.
Yeah.
That is the corporate equivalent of saying we intentionally abandon a massive chunk of our customer base.
Pretty much.
Understanding that a full third of their volume drop in the Americas was entirely intentional, that leads us to the most aggressive strategic pivot discussed on the call. Goodyear is actively, purposefully walking away from the budget-conscious consumer.
The transcript shows that Goodyear is experiencing significant market share losses in lower-tier segments. Specifically, we are talking about tires engineered for wheel rims smaller than 18 inches.
Right.
These are the 15, 16, and 17-inch tires that typically go on older sedans, basic daily commuter cars, budget-friendly vehicles.
And in that smaller rim segment, competitors, primarily budget-focused brands and low-cost imported tires, they are slashing their prices to the bone just to secure shelf space in retail stores.
And historically, a massive legacy manufacturer like Goodyear might have engaged in that price war. They might have matched those aggressive discounts, accepting a much lower profit margin, simply to keep their volume up and keep those massive factories running at full utilization to avoid the unabsorbed overhead penalty we just talked about.
But Mark Stewart's response to this price war was definitive. He explicitly stated that Goodyear will not, quote, chase volume into a non-profitable zone.
Instead of fighting for the budget buyer, Goodyear is actively shrinking its overall footprint to protect its profitability. They're dedicating their engineering, marketing, and manufacturing resources almost exclusively to what they define as power lines.
Power lines.
Yeah, these are premium tires built for 18-inch rims and larger. We're looking at brands like the Max Life 2, the Weather Ready 2, and their newly launched Eagle tire line, which is supported by their premium Fast Is In Us marketing campaign.
So what does this all mean for the broader economy? I mean, Stewart anchored this entire strategy to the concept of the K-shaped economy. And I think this is a vital economic theory for understanding the post-pandemic world.
It really is.
Imagine the letter K. You have a single vertical line representing the starting point. From the middle of that line, one arm angles sharply upward and the other arm angles sharply downward. It perfectly illustrates an economic environment where different demographic groups experience wildly different realities simultaneously.
And the top arm of the K represents the wealthier consumer demographic.
Yeah.
These are the individuals purchasing luxury SUVs, high-end crossover vehicles, premium electric vehicles. These modern vehicles require massive 18, 19, or 20-inch rims.
Huge tires.
Yeah. And according to Goodyear's internal data, this premium pricing tier is proving remarkably resilient to broader economic anxieties. Those consumers are largely ignoring inflation. They continue to buy expensive, high-performance tires without hesitation.
But the bottom arm of the K represents the middle and lower income tiers. You know, the everyday commuter driving an older vehicle. When gasoline is $5 a gallon and grocery bills are soaring, this demographic is highly sensitive to inflation. They simply do not have the disposable income to invest in a premium, high-mileage tire.
No, they don't.
When they get a flat, they are hunting for the absolute cheapest tire legally permitted on the road.
And Goodyear's calculation is that the raw materials and labor required to manufacture a tire have become so expensive that they can no longer profitably serve that bottom arm of the K. They are ceding that territory to the budget brands and focusing their entire global apparatus on the VIPs at the top of the K.
Okay, I have to push back on this, because isn't this strategy incredibly dangerous? It sounds like Goodyear is deciding to only be the VIP lounge of the tire world. There are tens of millions of everyday commuters who rely on 16 and 17-inch tires. By completely abandoning the budget-conscious middle class during an inflationary period, they are walking away from massive revenue streams. Shrinking their target market so drastically seems like a recipe for long-term irrelevance.
It's a calculated gamble, for sure.
Yeah.
And to understand why they believe it will succeed, we have to examine the underlying mechanics of automotive manufacturing. We need to look at the relationship between original equipment, or OE, and replacement tires.
Right. Original equipment tires are the ones that are physically bolted onto a brand new car as it rolls off the assembly line. When an automaker like Ford or Audi designs a new vehicle, they don't make the tires. They sign a massive multi-year contract with a company like Goodyear to supply the OE tires for that specific vehicle platform.
The alternative is the replacement tire market, which is what happens 3 or 4 years later when the original tread wears out and the consumer has to go to a retail shop. Here is the vital data point from the Q1 transcript. Even as Goodyear's overall sales volume fell dramatically, they actually increased their original equipment market share by roughly 2 full percentage points in both the Americas and EMEA regions.
Winning 2 points of global OE market share from competitors is a massive engineering and sales victory. And it creates an incredibly powerful, almost invisible pipeline for future profits. Think about human psychology.
Yeah.
When you buy a brand new car, you assume the engineers at the automaker spend years testing the aerodynamics, the suspension, the safety features. You trust that the tire they chose is the optimal tire for that machine.
So when that initial set of tires eventually wears down, the vast majority of consumers take the path of least resistance. When the mechanic asks what tires they want, the consumer says, just put the exact same ones back on. The psychological validation provided by the automaker creates a deeply sticky consumer behavior. By aggressively winning the OE contracts to put their premium 18-inch plus tires on the high-end cars being manufactured today, Goodyear is virtually guaranteeing highly profitable replacement sales 3 to 5 years in the future.
They are seeding the market. They are locking in that top arm of the K-shaped economy for the next decade. And we don't just have to guess if this works in theory, because the transcript provides a real-world case study. We just have to look at their operations in the Asia-Pacific region.
Oh, absolutely.
In Asia, premium tires, those 18 inches and larger, they now account for an astonishing 55% of all consumer sales. That is a massive 4-point jump from the previous year.
More than half of their entire consumer business in that region is now situated in the high-margin premium category. And the financial results attached to that metric are striking. This reveals a broader truth about Goodyear's current operational state. They are a single global entity, but they're experiencing 3 vastly different regional realities.
Let's map this out. We are looking at the Americas, EMEA, and Asia-Pacific. If Goodyear is a massive 3-engine cargo plane trying to navigate a severe economic storm, the status of those engines is incredibly varied. Right now, one engine is sputtering and dragging the plane down, one engine is actively being disassembled and rebuilt mid-flight, and one engine is roaring at maximum thrust, single-handedly keeping the entire operation in the sky.
That framework perfectly captures the regional variances. The sputtering engine is the Americas. As we discussed, they're dealing with massive destocking and intentional volume losses in the budget consumer segment. But the Americas are also being dragged down by a severe macroeconomic issue outside of the consumer market, a multi-year downturn in U.S. commercial crate.
The commercial tire business. We're talking about the massive, highly engineered tires that go on 18-wheelers, the lifeblood of the logistics supply chain.
Following the pandemic, consumer spending habits shifted radically. People stopped buying as many physical goods, televisions, furniture, home gym equipment, and started spending their money on services, experiences, and travel. Because fewer physical goods need to be shipped across the country, there are fewer semi-trucks actively running routes.
Right.
When trucks sit idle, the tires don't experience wear and tear. Therefore, commercial trucking fleets aren't buying replacement tires.
And a commercial truck tire isn't a cheap purchase. It is a massive profit center for a manufacturer. When the logistics supply chain freezes up, the financial impact on a company supplying the physical infrastructure of that chain is devastating.
Which brings us to the engine currently undergoing mid-flight maintenance. AMEA, encompassing Europe, the Middle East, and Africa. The operating income for this massive geographic territory was a shockingly low $1 million.
$1 million in profit for operations covering a continent and a half. I mean, for a multi-billion-dollar enterprise, that borders on a rounding error.
It highlights how aggressively they are restructuring their European operations. They deliberately walked away from massive volumes of low-margin products. More significantly, they executed a major strategic shift by successfully relaunching the Cooper brand to replace their older, less profitable Dunlop volumes. The transcript noted that this relaunch exceeded management's expectations.
They're swapping out the fundamental architecture of their European brands while still trying to operate. And the long-term OE strategy seems to be holding there as they achieve their 9th consecutive quarter of original equipment market share gains in EME.
It is also vital to note, because analysts specifically inquired about this, that despite the devastating ongoing conflict in the Middle East, management explicitly stated that their direct volume exposure to the region is immaterial.
Okay, that's interesting.
Yeah, the anemic $1 million project isn't the result of geopolitical conflict destroying their sales base. It is the result of their own internal structural teardown, combined with generally weak European economic demand.
So the Americas are struggling with freight recessions. EMEA is being rebuilt from the ground up, which leads us to the single engine keeping this company airborne, the Asia-Pacific region. APAC is the absolute crown jewel of this earnings report.
The financial contrast is immense. Operating income in the Asia-Pacific region surged 27% year over year, reaching $57 million. Even more impressively, they expanded their profit margins to 12.5%, a vastly healthier operational state than the Americas.
What makes those numbers truly fascinating is that they achieved a 27% surge in profit, while overall unit volume in the region actually dropped by 3.8%.
This is the premium pivot strategy executing flawlessly. The overall volume dropped partially because the Chinese government reduced incentives for purchasing new electric vehicles, which temporarily cooled the broader auto market. Yet despite selling 3.8% fewer tires overall, their premium product lines grew by nearly 30% year over year.
So they're manufacturing and shipping fewer physical objects, but making significantly more money because the objects they're shipping command a massive premium. But why is the Asian market adopting these luxury 18-inch plus tires at a 30% growth rate, while the American market is stuck fighting over budget tires for 16-inch rims?
It comes down to the structural reality of the vehicle fleets on the road. The Asian auto market, led by China, has rapidly leapfrogged Western markets in the widespread adoption of high-end electric vehicles. The physics of an EV fundamentally alter tire requirements.
Right, an EV doesn't operate like a traditional gas-powered car. An internal combustion engine builds up torque gradually as the RPMs increase. An electric motor delivers 100% of its torque the instant you press the pedal.
That instant massive torque physically rips the tread off a standard tire. Furthermore, EVs are incredibly heavy due to the massive lithium-ion battery packs lining the floorboards. A standard tire sidewall would simply collapse under the cornering weight of an EV. Finally, because EVs don't have a loud engine to mask the sound of the road, the tires require specialized acoustic foam liners to dampen the road noise.
So you cannot put a cheap 15-inch budget tire on a modern, heavy, high-torque EV. The vehicle demands a highly specialized, premium, large rim tire. The Asian market is structurally built to consume the exact high-margin product Goodyear is trying to sell. Meanwhile, the American consumer is holding onto their aging gas-powered sedans because interest rates on new car loans are too high, meaning they just need a budget tire to keep their old car running.
However, management did point to some crucial economic indicators suggesting the America's engine might finally be catching a spark, specifically regarding the commercial trucking market. They noted that freight capacity is beginning to tighten.
In the logistics world, tightening capacity means the excess supply of empty trucks is drying up. When capacity tightens, the spot rates the prices shippers pay to move goods, they start to climb. Truckers start making more money per mile, which means they can afford to run more routes and buy new equipment.
Management specifically cited the PMI, or the Purchasing Managers Index. The PMI is a monthly economic survey of supply chain managers across the country. It measures new orders, inventory levels, production, and employment. A PMI reading below 50 indicates the manufacturing economy is contracting. A reading above 50 indicates expansion. Management highlighted that the PMI has finally crossed back above 50, signaling that the long, painful freight recession might be ending. As factories produce more goods, more trucks will be required to haul them, leading directly to commercial tire sales.
While regional dynamics like the PMI and EV adoption dictate sales volume, global geopolitics dictate the cost of raw materials. And this is where the earnings call takes a dark turn, outlining a massive threat to the second half of 2026. While their direct sales exposure to the Middle East conflict might be immaterial, the economic ripple effects of that instability are threatening to crush their manufacturing margins globally.
We have to examine the chemistry of their supply chain. At the center of this threat is crude oil. Based on spot prices in late April, crude oil was hovering around $106 per barrel. That level of pricing introduces extreme volatility into Goodyear's manufacturing costs.
When most people look at a modern tire, they don't see a barrel of oil. But a tire is fundamentally a complex petrochemical product. While they do use natural rubber harvested from trees, the majority of the tread and sidewall relies heavily on synthetic rubber. And synthetic rubber is quite literally born from a barrel of crude oil.
CFO Christina Zamaro provided precise details on this chemical dependency. When crude oil is refined, one of the byproducts is naphtha. Petrochemical plants use a process called cracking to break down the naphtha into fundamental monomers, specifically butadiene and styrene.
Okay.
These chemicals are then linked together in a process called polymerization to create styrene butadiene rubber, or SBR, which is the primary synthetic compound used in tire treads.
So when the price of crude oil spikes to $106 due to geopolitical fear, the cost of extracting butadiene and styrene skyrockets almost immediately. Zamaro also mentioned pigments, processing chemicals, and heavy oils. Every single raw ingredient requires fossil fuels to produce or transport.
The financial projections attached to this chemistry are daunting. Management warned that if oil spot prices hold, it will create a massive $200 million raw material headwind. By the second half of the year, that number expands to a projected $300 million headwind compared to their earlier forecasts.
$300 million.
Yeah, $300 million in unexpected manufacturing costs threatens to wipe out the hard-fought profits they are generating through their premium pivot.
Interestingly, you mentioned earlier that the AMEA region was somewhat shielded from this energy shock. How does a manufacturing plant protect itself from global oil spikes?
Through the strategic use of futures contracts and industrial hedging. Management revealed that they had fixed roughly 75% to 80% of their energy rates in the AMEA region before the geopolitical conflict escalated. Industrial operations consume massive amounts of natural gas and electricity. Instead of paying whatever the market rate is on a given day, their procurement team signed long-term financial contracts, locking in the price of their utility bills at a lower historical rate.
They essentially bought financial insurance against an energy spike. It protects the cost of keeping the lights on and the ovens hot in their European factories. But that hedge does absolutely nothing to protect them from the physical cost of the butadiene and styrene they must purchase globally to build the tires.
Exactly. They still have to buy the chemicals at the inflated spot price.
And this exposes a highly damaging dynamic discussed during the Q&A segment of the call, the structural lag of indexed agreements. Let's explore the structural lag because it perfectly illustrates why global inflation often tortures the manufacturer long before it ever reaches the consumer. Let's go back to those original equipment contracts the tires sold directly to automakers like Ford or Toyota.
To protect themselves from volatile commodity markets, Goodyear structures about 1/3 of their massive OE contracts to be mathematically indexed to raw material costs. In theory, this is brilliant. If the price of crude oil goes up, the contract legally permits Goodyear to raise the price of the tire they sell to the automaker. It is a built-in inflation defense.
In theory. But the reality is much more painful because these index contracts only reset every 6 months.
There is a massive temporal lag. If oil jumps to $106 today, Goodyear immediately has to start paying inflated prices for styrene and butadiene just to keep the assembly lines moving. They are absorbing massive financial damage in real time. But they cannot legally pass those costs on to the automaker until the 6-month contractual window closes and the pricing resets.
They are acting as a massive financial shock absorber for the entire automotive supply chain. They eat the inflation today, severely damaging their quarterly earnings, and simply hope to recoup the losses 6 months later. And the dynamic is even worse on the consumer replacement side of the business. Let's introduce a concept that is the ultimate paradox for a tire company: VMT, or vehicle miles traveled.
VMT is the foundational metric of the entire industry. It simply measures how many miles the aggregate population is driving. High VMT equals high tread wear, which equals high replacement sales.
Here is the paradox. When crude oil hits $106 a barrel, it massively spikes Goodyear's manufacturing costs. But what happens to the consumer when oil is at $106? Gasoline prices at the local pumps surge past $5 a gallon, and when fuel is that expensive, consumer behavior changes instantly.
People consolidate their errands, they cancel long weekend road trips, they utilize public transit or opt to work from home more frequently. The overall vehicle miles traveled plummets.
If the consumer isn't driving, they aren't wearing down the tread on their current tires. The $106 oil simultaneously makes the tire vastly more expensive for Goodyear to manufacture, while extending the lifespan of the tires already on the road, effectively destroying consumer demand right at the moment Goodyear needs revenue the most.
It is a brutal macroeconomic trap, and it highlights a fundamental truth about corporate survival. When external forces, geopolitical war, oil cartels, inflation, and shifting consumer behavior are simultaneously attacking your profit margins, you cannot control the outside world. You can only control what happens inside your own walls.
You have to aggressively control the controllables. Which brings us to the internal transformation plan that management referenced repeatedly: Goodyear Forward.
Goodyear Forward is not just a corporate buzzword. It is a surgical, aggressive restructuring of how the company operates. And the financial results of this internal discipline are significant. The transcript explicitly states that the Goodyear Forward plan generated $107 million in operating income benefits in the first quarter alone, and is projected to deliver an additional $90 million in the second quarter.
They are achieving this by fundamentally altering the financial anatomy of the business. One of the clearest indicators of this austerity is the drastic reduction in capital expenditures, or CapEx. This is the budget dedicated to acquiring, maintaining, or upgrading physical assets like factory machinery, robotics, and real estate. They are slashing their global CapEx budget to $725 million.
Reducing CapEx preserves massive amounts of cash. Furthermore, management indicated that more unannounced restructuring actions are imminent. While they withheld specific details, they made it explicitly clear that the Americas region will be the primary target of these cuts due to its historically high cost base. They expect a rapid 1 to 2 year financial payback on whatever structural cuts they are preparing to announce.
They also detailed a $50 million rationalization plan in the AMEA region designed to streamline their complex sales and distribution networks. And they highlighted a sudden $46 million financial benefit resulting from the successful navigation of an IEPA tariff adjustment.
An IEPA, or indirect export pricing adjustment, involves complex cross-border trade mechanics. When a company imports raw materials, manufactures a product, and then exports that finished product across different international trade zones, they are subject to myriad tariffs and indirect taxes.
Yeah.
By restructuring their supply chain to optimize for these specific international economic agreements, they were able to legally reclaim or avoid $46 million in indirect taxes.
Wow.
Yeah, it's an example of finding profit not by selling more tires, but by mastering the bureaucratic architecture of global trade.
But the true battleground for controlling costs happens on the factory floor. We discussed earlier the massive financial penalty of unabsorbed overhead when a factory runs below capacity. The CEO talked about the vital importance of achieving cost flex. What does cost flexing actually look like in the physical reality of a massive industrial plant?
In a traditional legacy manufacturing environment, overhead costs are rigidly fixed. If customer orders drop by 20%, you still employ the same number of floor workers, run the same maintenance schedules, and consume roughly the same baseline energy. True cost flex requires building an operational system so agile that if volume drops by 20%, the plant manager can immediately trigger a commensurate drop in operating expenses.
How is that practically achieved without simply shutting down the plant and laying off the workforce?
It requires extreme granular control over indirect spending and operational physics. When orders drop, a plant manager with strong cost flex doesn't just keep the vulcanization ovens running empty. They implement highly orchestrated power-down CAM suites for non-essential lines to reduce the baseline electrical draw. They aggressively target indirect spend. This means instantly pausing external contracts for facility maintenance, delaying the purchase of auxiliary supplies, and utilizing flexible labor scheduling to eliminate all overtime hours.
Every single dollar that does not directly contribute to the chemical curing of a tire is immediately frozen.
Okay, I have to challenge the long-term viability of this approach, specifically regarding the drastic cuts to capital expenditures. Let's look at the broader strategy. Goodyear is aggressively trying to pivot away from budget tires to become the premier supplier of luxury 18-inch plus tires for high-end electric vehicles. If you are trying to market yourself as the absolute pinnacle of premium automotive engineering, is slashing the budget for new robotics, advanced machinery, and factory upgrades a logical move? It sounds like trying to build a luxury watch in
a discount tool shed.
Oh,
exactly.
Right? It makes no sense.
That is a highly critical observation, and it echoes the exact concerns Wall Street analysts raised during the Q&A portion of the earnings call. If a company starves its factories of the capital required to innovate, how can they deliver a premium product? Management's defense is that they are not starving the future. They are entirely restructuring how they deploy capital.
They pointed to the creation of an advanced global engineering team to manage these purchases.
Historically, a massive multinational company might allow regional factory managers in Ohio, Germany, and China to individually negotiate and purchase the specific machinery they need for their local plants. It is highly decentralized. Goodyear Forward changes that by centralizing all capital purchasing through a single global engineering authority.
The concept of bundle buying.
Precisely.
If 3 different factories globally need new extrusion machinery over the next 2 years, the central team negotiates a single, massive global contract with the equipment manufacturer. By leveraging their global scale, they command significantly lower prices for the exact same advanced technology. It is not about buying inferior equipment. It is about eliminating the massive inefficiencies of regional procurement. They believe they can continue to build that precision Swiss watch, but they have figured out how to buy the high-end tools at a wholesale discount.
They will need every ounce of that operational efficiency because as we look toward the second half of 2026, the external macroeconomic environment remains deeply unpredictable. This brings us to the final piece of our analysis: the forward-looking guidance, the looming specter of international trade wars, and the geopolitical maneuvers that could radically alter Goodyear's trajectory.
Management must provide Wall Street with a baseline assumption for the upcoming 90 days. For the second quarter, they are clearly bracing for continued contraction. Their internal models project that the consumer replacement industry will drop an additional 3% in North America and China and drop 2% in EMEA. Furthermore, the commercial trucking side is expected to suffer a brutal 12% decline in North America as the freight recession slowly attempts to bottom out.
However, there is a strange temporary silver lining before the massive $300 million oil shock hits in the second half of the year. Due to the complex timing of inventory accounting, raw materials will actually provide a $100 million financial benefit in the second quarter.
Yeah, that timing is interesting.
But the most consequential story looking forward isn't about internal accounting. It is about global government policy crashing into corporate strategy.
The transcript specifically noted a vital shift in the U.S. trade environment. Non-member tire imports into the United States were down 7% in the first quarter. This indicates that the sheer volume of cheap, heavily discounted imported tires flooding the domestic market is beginning to recede. But the truly massive catalyst on the horizon is unfolding in Europe. Management highlighted that a final decision regarding European Union tariffs targeting Chinese consumer tire imports is expected by midsummer.
Let's explain the geopolitical mechanics behind this, because a tariff isn't just a random tax. Why is the European Union stepping in to specifically penalize Chinese tire manufacturers?
It revolves around the concept of state-subsidized manufacturing and dumping. In a purely free market, a factory only produces tires if there is organic consumer demand to buy them at a profitable price. But in heavily state-managed economies like China, manufacturing facilities are often deeply subsidized by the government through artificially cheap electricity, low-interest state loans, and subsidized raw materials.
The goal isn't necessarily corporate profit. The goal is maintaining massive domestic employment and industrial dominance.
Exactly. So when the domestic Chinese auto market slows down, these massive factories don't halt production. They keep churning out millions of tires. To get rid of this excess inventory, they export the tires to foreign markets like Europe and sell them at prices that are often lower than the actual cost of the raw materials required to make them. This practice is called dumping.
A legacy manufacturer like Goodyear, paying European Union wages and market rate energy prices, mathematically cannot compete with a state-subsidized tire being dumped below cost. So the European Union investigates, and if they prove the dumping is occurring, they implement massive tariffs, essentially a heavy border tax on those specific imported tires to instantly raise their price and level the playing field for domestic manufacturers.
If Brussels implements these tariffs by midsummer, it could represent a massive financial windfall for Goodyear. The artificially cheap budget options currently destroying their market share in Europe would vanish or become prohibitively expensive overnight. This bureaucratic action would immediately restore Goodyear's pricing power and surge their European market share without them having to change a single thing about their manufacturing process.
They're essentially waiting for the stroke of a bureaucratic pen to radically improve the profitability of their entire AMEA operation. And while they wait for government intervention to protect their consumer business, they are actively building their own strategic defenses to protect the commercial trucking business. This leads us to their concept of cradle-to-grave fleet solutions.
This is a brilliant evolution of their business model. And when Goodyear approaches a massive commercial trucking fleet, they are no longer just selling a highly engineered piece of rubber. They are selling a comprehensive, technology-driven life cycle management system.
A true cradle-to-grave ecosystem.
It begins with the sale of the new commercial tire, but it immediately extends into preventative maintenance. They install digital sensors inside the tire to monitor real-time pressure and temperature data, predicting blowouts before they happen and saving the trucking company massive downtime. When the thick tread eventually wears down, Goodyear doesn't just sell them a new tire. They pull the tire into their own facilities and provide retreading services.
Explain retreading, because this is unique to massive commercial tires.
The casing of a commercial tire, the heavy structural sidewalls and steel belts, is incredibly durable and designed to outlast the rubber tread that physically touches the road several times over. Retreading involves shaving off the last remnants of the old tread and literally vulcanizing a brand new layer of thick tread rubber onto the existing casing. It provides a massive cost savings to the trucking fleet compared to buying a completely new tire while keeping them locked into the Goodyear service ecosystem. Finally, Goodyear provides comprehensive mechanical service and emergency roadside assistance across a nationwide network.
They have transitioned from selling a physical commodity to selling a subscription-like service for physical mobility. This comprehensive ecosystem acts as the ultimate competitive moat against cheap imports. A fleet manager might be tempted by the upfront price of a heavily discounted, dumped, imported tire, but that cheap tire doesn't come with digital predictive sensors, it can't be safely retreaded, and it doesn't include a nationwide network of mechanics ready to deploy when a truck blows a tire on a remote highway at 2:00 a.m.
The service infrastructure itself becomes the product. It is a highly effective way to insulate their most profitable products from the volatility of international price wars.
It is an incredibly delicate high-wire act. If we summarize the sheer number of variables management is currently juggling, they need the American manufacturing PMI to stay above 50 so the commercial freight recession finally ends and 18-wheelers start moving again. They are relying heavily on the European Union to implement aggressive protective tariffs this summer to eliminate cheap state-subsidized competition. They are betting the future of their consumer business on the hope that the upper middle class continues to ignore inflation and purchase premium 18-inch EV tires, despite gasoline hovering above $5 a gallon. And they must execute flawless, ruthless internal cost-cutting on the factory floor while bracing for crude oil prices to add $300 million in surprise manufacturing costs.
It is a staggering number of macroeconomic dominoes that all need to fall in exactly the right sequence within a highly chaotic and unforgiving global environment.
This analysis perfectly illustrates why looking at these earnings calls is so valuable. You don't need a deep passion for the automotive industry to understand the significance here. This single company bridges complex, high-level macroeconomic theories like the K-shaped recovery, the structural lag of inflation, and international trade tariffs with the daily mundane reality of an average person driving to the grocery store. The macro truly is the micro.
The physical product forces all those abstract economic theories to manifest in the real world.
As we wrap up this deep dive into the source material, I want to leave you, the listener, with a final, somewhat provocative thought to mull over. Something that wasn't explicitly stated on the earnings call, but echoes loudly beneath all these corporate strategies. If trusted, century-old legacy manufacturers like Goodyear completely vacate the budget-friendly tire market because the raw materials are too expensive. Who steps in to fill that massive void for the lower and middle class?
That's a huge question.
Are we witnessing the permanent fracturing of the automotive market? We could be moving toward a reality where basic, reliable physical mobility is no longer a standard utility, but a luxury reserved only for those who can afford 18-inch premium rims. If the everyday commuter is entirely priced out of high-quality, heavily engineered routine maintenance, what happens to the safety of our highways? What happens to the resilience of the local supply chains if budget commuters are relying on unproven, cheap imports that fail at higher rates? The diagnostic X-ray of the global economy might be showing us a structural fracture that is much deeper and more dangerous than a simple supply chain hiccup.
It's definitely something to think about.
It is a profound question about the future of access, safety, and mobility. Something to consider the next time you are on the highway, looking at the tires on the cars passing by. Thank you for joining us on this extensive journey through the source material. We appreciate your curiosity, and we'll catch you on the next deep dive.